This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Peter Boockvar joining us this morning. Peter is Managing Director, Chief Market Analyst with the Lindsay Group, a macroeconomic and market research firm, and he is well known for his regular appearances on CNBC. Welcome, Peter.
Thanks for having me.
Well, it's our honor to have you join us. Peter, we've had a lot of guests on talking about financial repression, but I'm sure that you have your own views and something quite different. Could you help our listeners with a description of your background of things that you've been involved with?
Well, I've been at the Lindsay Group for now almost 2 years. As you mentioned, the chief market analyst. Prior to that, I was at Omega Advisors, the hedge fund, as a macro strategist, and prior to that, for 18 years, was the equity strategist in Militabex. I've been following markets not just here but all over the world. And not just stocks, but fixed income, currencies, commodities, and of course the influence that central bankers have had on all those markets.
And everyone, they certainly have. And I would argue that we've reached the point where we have mispricing of risk, we have lack of price discovery, and we have malinvestment. But I don't want to put words in your mouth. So, Peter, could you define financial repression to our listeners, what it means to you or how you think of it?
I think, well, generally speaking, when central banks are involved in setting interest rates, it's the price fixing of the cost of money. And I guess financial repression would be the artificial suppression of interest rates well below at least the rate of inflation and well below where they would be otherwise if set by the supply and demand for money. I mean, that's what really should create the cost of money, is the supply and demand for it. And again, central banks artificially setting them at well below the rate they would be otherwise would be my definition of financial repression.
Consequences of them doing that, positive and negative?
Well, of course, as you mentioned before, the malinvestment. But when you think about central banks and what they do, they're not creating anything new. They're just they're just trying to pressure you to act today in some activity that you may have done tomorrow. They want you to buy a car today, not tomorrow. They want you to buy a house today, not tomorrow. They want you to buy that stock today, not tomorrow. So it just pulls forward activity. So when that initially begins, activity in the short term obviously accelerates, both in terms of economic activity and higher asset prices. But at some point you reach a wall where you pulled forward so much activity that you've reached the law of diminishing returns. We've certainly seen that in the economy over the past 5 or 6 years in this recovery. But on the other hand, asset prices have been, the inflation in asset prices have pulled forward a lot of future returns, but that hasn't stopped asset prices from continuing higher. So that's what it does. There's a short-term high to it, but in this process, as you said, the malinvestment. So in the late 90s, for example, we laid a lot of fiber optic copper wires and so forth. So while that would have happened ordinarily, you bunched a lot of the activity in a very short period of time. Housing. A lot of these houses over a period of time, just due to household formation, would have been built. But the Fed's artificial suppression of interest rates caused a lot of that building to happen all at once. We saw it in the oil patch. A lot of these new hydraulic fracking wells would have been drilled, but the low cost of money, cheap financing, caused it all to be drilled all at once. So that's what happens. It's a short-term benefit, but at major long-term costs that you pay the price for a long time.
Peter, how I look at it quite in a similar manner to you, and so it brings all this demand forward, and then what happens is the corporations go out and build supply to match it. So, and at some point with cheap money, and we've certainly seen that in Asia, as it's geared up at phenomenal rates of of building supply, but at some point it reaches equilibrium of the demand and supply, but at a very elevated level. And to keep it at that level, you got to bring even more demand forward, and it's pretty tough to do that, diminishing returns and zero interest, and it gets harder and harder to bring it through. And then what happens, as soon as that demand kind of weakens a little bit, all of a sudden the supply guys absolutely cut back in manufacturing, commodities. You see it in the Baltic Dry, you see it in the commodities prices, etc., because they've got to cut back costs associated with even beginnings of a slowing demand. Am I right in that? Is that the right way to look at it?
Yes, and that's the irony of central bankers' attempt to generate higher inflation end up causing the scenario and the environment that ultimately creates the deflation, because all they're doing is creating excess capacity.
Precisely. And is that not what we're seeing right now? This deflation is now alive and well because of exactly that? And is this the beginnings of some serious problems?
It's a deflation in commodity prices. I don't want to say there's broad deflation, because in the U.S.,
correct, I agree.
Services ex energy is persistently up 2.5% year over year every month. So it's disinflation, deflation, whatever you want to call it, in commodity prices is predominantly what we've seen.
But we're certainly seeing inflation in many areas, professional services noticeably so.
Rents, tuition,
there's no
taxes.
question. And then we're seeing quite a mixture between economies. Some economies are experiencing more deflation, whereas a lot of the emerging markets have been experiencing severe inflation right across the board.
Right, exactly, particularly Brazil.
Yeah.
But some deflation sometimes is good. From where I come from, the United States, when prices get cheaper, it increases the demand for those goods. Look at Europe right now. Lower prices, at least in Spain, has helped that country to become more competitive, both from a labor standpoint and also from a wage and income standpoint. So it's part of the process of readjusting prices to where demand and supply are, but we know that central bankers have basically mucked up the entire concept of supply and demand and price discovery, and has caused all these different inputs to be completely out of whack relative to where they would be historically.
Where does it end? Or does it just keep on going on?
No, unfortunately it ends when inflation actually does start to increase and interest rates do start to rise, and in a sense take away the printing press of these central bankers. So right now central bankers have given themselves license to do what they want because of these low levels of inflation. But at some point, the bond market and these inflation numbers are not going to be so accommodating, and that's what will inevitably take this away. But the first step in that, I think, is the central bank of the Fed central bank, as people get to see how they are trapped in a policy that they can't get out of, and that here we are 9 years after the last time we've had interest rates go up, 6 years at zero, and everyone's freaking out over a measly 25 basis point increase in interest rates.
Of only talking about doing it. We haven't seen it actually happen either.
Well, I think, assuming if you fast forward to June and we're under the same environment as we are today, they will raise 25 basis points. We have to remember that central bankers, particularly in the Fed, are academics who follow econometric models.
Yeah.
And their labor market inputs are flashing red. And that's why they will raise rates in June. Now, whether that's the right thing to do or not is not part of this discussion. They want to raise rates, and if the labor market continues to behave in the way it has over the last few months, over the next few months, and the unemployment rate, for example, regardless of what you think of that number, is down to 5.3, 5.4, the Fed will raise rates in June. So the question is not that first rate hike, it's the turbulence that causes and what that potentially means for future rate hikes after the first one.
Won't this just continue to strengthen the U.S. dollar relative to other currencies, putting pressures in profits, ever mind problems in the emerging markets?
Yeah, that's the catch-22 here. But
wouldn't it force China? Wouldn't it force China? Because China's facing horrendous issues now with its currency relative to the yen, etc., because it's trying to keep a relative I'll use the word peg against the U.S. dollar. So isn't it going to force them into some kind of action?
Well, it's interesting with the yuan because the yuan is weakening against the dollar, but it's strengthening against the euro. So the yuan is not a one-way street against all currencies. It's a very mixed bag with the yuan. And China takes a lot of pride in having a strong currency. So I'm not necessarily convinced that the yuan is going to have some big fall because China doesn't want that to happen. But I don't think that's the issue with China. I don't think that's going to be one of their problems. But yes, the dollar strength is eventually going to be a problem for the Fed. But raising 25 basis points, we've had an extreme move already. So I think potentially a lot of that has been priced in. It's really what happens after that. And also a big part of the dollar discussion is going to be related to commodities too, because commodities are obviously having a really tough time here, particularly oil. But after the crash that a lot of these commodities have had, this trend's not going to last forever, and low prices will cure low prices. And when commodity prices stop going down, and I'm not sure when that is, but I'm convinced that the decline in oil is the last phase of this commodity bear market. It can go on, but to me this is the last phase, a phase that began with silver back in early 2011, followed by gold in September 2011. So once you get commodity prices firming, and again, I don't know when or from what level, the dollar against some currencies will stop rallying. It'll stop rallying against the Canadian dollar, the Aussie dollar, and potentially the Brazilian real. You also have to see how the ECB QE program unfolds in coming months. If all of a sudden, fast forward to September, they start having issues with finding enough bonds to buy, well, maybe they're not going to be able to get to the 3 trillion euro balance sheet that they hope for, and that actually can end the euro decline. So there are a lot of factors here. The dollar is not rallying because the U.S. is a great place and because the Fed may raise rates 25 basis points. It's happening because of so much turmoil in a lot of these other countries, whether it's commodity-based or it's massive QE going on in Europe and Japan.
What's your outlook right now for the U.S. equity markets in 2015? What are you anticipating with these, even with these rate increases in potentially in June?
Well, I unfortunately started to be a bear in late 2013, way too early, because I was worried when the Fed was going to taper that was going to be the end. So I'm in the camp that central bankers, particularly the Fed, have been the main support to U.S. equity markets. Mm-hmm. And now that the Fed is tightening, and the Fed tightening is not beginning with the 25 basis point hike. The Fed tightening began with the end of QE. So at the end of QE, what I think they will be a hike in rates, the stronger dollar, data point after data point that's missing expectations, earnings expectations that continue to shrink with Q1 and Q2 year-over-year earnings growth expected to be negative. So I'm even more bearish on the U.S. stock market and think a major correction is potentially just beginning.
Any idea what kind of size this is, or is this a consolidation before we go higher? Or
to me, the fundamental factors aren't in place for a resumption of the bull market. Again, mostly because of Fed tightening and combined now with a changed earnings picture. Mm-hmm. Earnings have been a major driver of the market, as we know, but so was multiple expansion. So the reversal of Fed policy ends the multiple expansion game, and the end of the V-bottom in earnings ends that part of the game. Now, to what extent do we decline? I don't know, because I'm not sure exactly where the Yellen put is today. It's an out-of-the-money put, but I'm not sure what the strike price is right now. I don't know if it's 15%. I don't know if it's 25%. But I'm pretty convinced that if we're down 20, 25%, she will not only possibly cut rates below where she had them after she raises them in June, but I wouldn't be surprised if we saw another round of QE. So saying where we go on the downside is tough, but I think that over the next 6 months we'll see potentially 15% or more, depending on what the Fed does.
Won't the Fed, before, as you say, whatever their strike price is, forced to take action because there's so much leverage in the system that any collapsing collateral values, and there's already a shortage of collateral in many cases out there because of things like rehypothecation, couldn't this get out of control very, very quickly? Isn't that their biggest worry?
The Fed will certainly try, but
exactly.
At some point they're going to lose control of the stock market, and they'll lose control of the bond market. We know they lost control of commodity prices. I mean, the Fed's trying to generate inflation, and commodity prices have gone the exact opposite way. Just look at gold since September of 2011 and all the money the Fed's printed, and gold has had this major correction. The Fed's lost control of commodities. And I guarantee you at some point, they're going to lose control of stock prices also. Certainly not from a lack of trying, but they will at some point, and that's when we have to get worried. I don't know when that point is going to be. I hope it doesn't necessarily happen because we don't want to see another repeat of 2008 or 2001, 2002. But we all have to remember that this is the third bubble in the last 15 years. This is obviously has different characteristics than the previous two, so we're not exactly sure how it plays out. But it's still a bubble nonetheless, and we know how bubbles end. We just don't know from what level and how bad it gets.
I would argue, too, that this bubble is not just a U.S. technology bubble or a housing bubble like 2000. This is a global bubble.
No question, and it's mostly manifested itself in the fixed income markets.
Exactly.
But everything else will not be immune from that when that bubble pops.
So you can't have a Fed run into the rescue. It's very difficult to have a coordinated manner across many countries to move very, very quickly. And if something breaks, it can be very tough to even put it back together.
There are no bullets left. There are no bullets left here. Going into the year, I said the ECB QE is the final act of global central bank largesse. These are the last bullets that are being expended, and that can carry things for a little while. But this is it. This is the final phase of all the central bank activism that we've seen. Starting with
Japan's Halloween surprise, and then the ECB. This is it. These are the last bullets.
This is it. This is the final act, and we'll have to see how this plays out.
So what should investors be doing then, Peter? What are you doing?
Well, I think when you're 6 years into a bull market, obviously a lot of things have been picked over. Valuations just get expensive when you've been rallying for 6 years. Therefore, it's tougher and tougher to buy cheap things. But I think investors have to be bold and go to places that have been thrown out the window. And we know commodities have been the poster boy for a bear market. So anybody who has investing guts and wants to be the contrarian has to be buying commodity-based stocks, commodities themselves, the countries that produce them, and know that in a couple of years when this bear market ends, prices will likely be a lot higher than they are today. So I think that's a main area that investors should be looking for value, because that's where the value is. When you have commodity prices essentially near the lowest level since 2009, find me any other asset class that has experienced that kind of damage. Therefore, things don't continue in that direction. This will eventually cure itself, as low prices will cure low prices, and you will see a resumption of a commodity bull market. Where it goes in the upside, I have no idea, but to me, that's where the tremendous values are.
There's a lot to worry about here. What's worrying you the most amongst all of these issues?
That central banks lose control, and I think we're beginning to see the beginnings of that. Certainly with European stock markets and bonds, they're carrying through with the ECB QE, but we're seeing major signs of instability here. So we've had central bankers in their attempt to create 2% inflation and what they call price stability has, in front of our eyes, caused major monetary, financial, and now foreign currency instability. So to me, they're already beginning to lose some control of the narrative, and that's what has me most concerned if this continues, particularly in the implications it has for fixed income and stocks. And I think people should be keeping a very close eye, at least in the next month, on the European bond market, because that's where the new central bank stranglehold is on. And if you see a repeat in Europe that we saw in the US when QE2 and QE3 began, where rates actually went up after the Fed began the programs, if that all of a sudden happens in Europe, well, then we potentially could have some problems globally with the rise in interest rates. So to me, central banks and them losing the faith of the markets is the biggest concern. I expect it to happen, but it'll be on a methodical pace, but one that I think we've already embarked on.
What's your feelings about gold, silver, precious metals this year? You obviously believe this is a time to take a risk on commodities. Would that include gold and silver?
I think about maybe 5 times over the past year I've called the bottom in gold and silver. So I guess I might as well try it again. I think from a fundamental standpoint, anything that you would want as a bull on gold and silver are taking place in front of our eyes. I think the only thing that's keeping gold back is this idea that it's just an anti-dollar trade when it's really just an anti-fiat currency trade. So I think the last roadblock to a resumption of the gold and silver bull market is that first rate hike from the Fed. I think once that is out of the way and people realize that this is not the beginning of some long extended tightening cycle, because the Fed's just not going to be able to pull it off, that rates are going to stay well below where they should for a very long period of time, that's when the gold and silver bull market will resume. But again, that first rate hike and the patient word and all that stuff is the last impediment here. And let's take a step back. The dollar's had an extraordinary rally over the past year to 18 months. And gold has pretty much stopped going down. And I think from a technical standpoint, that says a lot. Now, can gold break its 1140 low on a short-term basis? Maybe. But give or take $50, gold has stopped going down with this ferocious rally in the dollar. And I think that says a lot, and people should not ignore that divergence.
Well, I believe we're at really the cash cost to produce a gold right now across the board generally. So
yep.
It's go any lower, they're going to start shutting down the gold mines, which is going to mean a supply problem. But it could go on a little lower. Our charts all say that we're very, very close to a long-term wedge, which is actually ending diagonal, which suggests that's a bullish sign. But time will tell on that one. That wasn't trading advice at all. Peter, any last comments you'd like to leave with our listeners? Key messages? Well,
just one more thing with gold. We're 3.5 years into a bear market. That's a very long bear market. You've exhausted a lot of selling. And I think people have to take a step back and see what these central bankers are doing. I mean, there's literally monetary madness going on. And don't just trade gold because you see the dollar goes up and you want to sell gold and vice versa. Okay? Because gold is not just a replacement of the dollar. It is a form of money for 5,000 years, and it's replaced all forms of fiat currency. So once we shake and disconnect from this dollar trade, gold and silver have the potential of going dramatically higher over the next couple of years. So try to put aside the short-term gyrations and whether we trade 1,100, 1,200, we break 1,140, we don't do it, and know that the risk to the downside is nothing like the potential upside from here.
It's a good insurance policy, it sounds like.
Yeah, so there's no doubt. But putting aside the insurance policy aspect of it, and listen, people should own gold and silver just to have it. But from a pure asset standpoint, and where do we make money in the markets? I would bet everything I have that over the next 5 years, gold and silver will well outperform the S&P 500 and fixed income. Key messages? Is that it? Is that what you think the key message you'd like to leave with our listeners? Investor, and one other thing in this investing world that's so complex that we're in right now, don't be afraid to own some cash. Cash is the most hated asset class probably outside of the metals. But cash is dry powder. Cash is optionality. Cash doesn't lose you money when other things go down. Maybe on a real basis, but on a nominal basis, it is something that I think investors should hold more of. Again, because I expect asset prices to correct over the next 6 months, and it allows you to take advantage of cheaper values, which I foresee coming. Peter, how could our listeners learn more about your writings, the work, and things you're involved with? The website of the firm is thelindsay.com, and you can learn more about us from there. Peter, been a pleasure. Thank you very much for sharing your views here today. I appreciate it, and we're going to have you back again and as the year goes on, because there's no question it's going to be another exciting year. Yes, very interesting. Thanks so much. Talk to you again. Have a good weekend. Yep, you too. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.